Now that we've done our sales budget and all of our production budgets and our selling and administrative budget, it's time to do our cash budget. So, somebody needs to tell us when we expect that our customers will pay us. And this is going to vary from firm to firm. In real life, you'd probably have to go talk to the credit manager. But in the case of a demonstration problem or a homework problem or a test question, somebody will tell you. As you can see, we have our projected sales. April, May, and June came from our sales budget in Part A of this chapter. The information from March would have been on the first quarter's budget. Somebody needs to tell us if we expect to get any cash from March sales in April or May or June. This particular firm sells all of its merchandise on credit, and it expects that it will collect about 75% of its accounts receivable in the same month when the goods are sold, and it expects to collect about 22% of that month's accounts receivables in the following month. That would be for sales that are made toward the end of the month, and it estimates that about 3% of its sales will never show up in the form of cash because those will be bad debt. Remember, bad debt is not good news or bad news, it's just news. If we thought that we could sell all of our goods for cash at the moment and not have to extend credit, of course we would do that, but we recognize that extending credit is part of the way that we need to operate in our particular industry. So as long as the additional sales that we get by offering credit are greater than the amount of sales that we never collect because the customers don't pay, we consider that it's a reasonable decision. So let's look at our firm's sources of cash. What happens in April? Well, one thing that happens is our customers who bought goods late in March will be paying us in April. We already estimated that we would have $360,000 of sales revenue in March, and according to our expectations, we should already have collected 75% of that amount in March. What we're going to collect in April is the other 22%. And then, of course, the last 3% will probably be bad debt. What else are we going to collect in April? Well, we expect to make sales in April. We estimated $400,000 of sales. That came from the sales budget. And we expect to collect 75% of that amount. If we add the money that we expect to receive for March sales in April, plus the amount that we expect to receive for April sales in April, that represents our total expected cash receipts from customers during that month. So what happens in May? One thing that happens is we expect to get another 22% of the cash for April sales. That would be from customers who bought merchandise later during April and paid us during May. In addition, we also expect to collect 75% of the cash from sales made in May. Add that up. It tells us the total expected cash inflows from customers during May. And if you notice, adding up the April cash received in April plus the April cash received in May, that has to equal 97% of April's sales revenue. The other 3% is our budgeted bad debt. So what happens in June? We expect to collect 22% of the cash from May sales and 75% of the cash from June sales. Add that up. It gives us the total cash from customers expected in June, and we can check our work by adding up the May sales that were received in cash in May plus the May sales that were received in cash in June, and that needs to equal our estimated 97% of the May sales revenue. The other 3% we budget that we will write off as bad debt. Altogether, this schedule of sources of cash tells us how much cash inflows we expect to have from our customers during this quarter. Let's do a practice problem. We have a company that estimates it will collect 40% of current sales in the same month and 55% of sales from the previous month, and they estimate 5% bad debt. My question to you is, based on this information, how much cash does the company expect to collect in May? Let's take a look. In May, we expect to collect 55% of the cash from sales made in April, and we can figure that out. In addition, we expect to collect 40% of the cash for sales made in May. Add that up, and it tells us our total expected cash inflows from customers in May. Naturally, a firm would never budget cash collections in May for sales made in June because those sales haven't happened yet. Now let's take a look at uses for cash. In order to figure this out, we need to know, when does Acme Widgets expect to pay its bills? We are told that the firm generally pays 60% of its manufacturing costs, that would be materials, labor, and overhead, in the same month when those bills are incurred, and 40% the following month. In addition, we're told that the firm had $30,000 of manufacturing costs in March, and of course we're going to look on the materials, labor, and overhead budgets to get information about April, May, and June. Now, what about operating expenses? Well, depreciation is a non-cash expense. The cash event associated with depreciation occurred when the firm bought a building or equipment or motor vehicles or machinery. So when we're doing a cash budget, we need to remember to subtract out the costs that represent depreciation expense, because depreciation doesn't actually take any cash out of our pocket. The journal entry for depreciation is a debit increase to depreciation expense and a credit increase to accumulated depreciation, which lowers the book value of the asset being depreciated. In this firm, we expect to pay all other operating expenses in the same month when they are incurred, and we need to remember to look at the selling and administrative budget from the previous section to determine how much those amounts might be. I've put this together into a chart. So first, we see that in March, we had expected to have $300,000 of manufacturing costs, and of course it doesn't matter what our operating expenses were because our cash operating expenses were paid in March. Now, what happens in April? We can add up the materials, the labor, and the overhead to get the total manufacturing costs for April. We can do the same thing for May, and we can do the same thing for June. What about our operating expenses? March was already paid. What are we going to have to pay in April? Well, we have $30,000 of selling and administrative costs, but $2,000 of that is depreciation. We subtract that out, and that tells us that we will need to pay $28,000. In May, we have $31,000 of selling and administrative costs, but $2,000 of that is depreciation. Subtract that out to find the cash operating expenses for May. And similarly, in June, take our total selling and administrative, subtract out the $2,000 of depreciation expense to get the cash operating expenses for June. Now, we can take all of these totals and put them together into a budget of when we are going to pay these various costs. So, the first thing I did was to take the amounts that were shown in red on the previous slide and bring them into this table. That is total manufacturing costs from April, May, and June, and the cash operating expenses for April, May, and June. Now we have to figure out how much of these costs are we going to pay in each month. So in April, we still have to pay 40% of March's expected manufacturing costs. In addition, we would expect to pay 60% of April's manufacturing costs, plus 100% of April's operating expenses minus depreciation gives us the total amount of cash that we need to have to pay our bills in April. What about May? We are going to pay the other 40% of our April manufacturing costs. By the way, the amount that we pay for April's manufacturing costs in April plus the amount that we pay for April's manufacturing costs in May must equal the total of April's manufacturing costs. We would never dream of failing to pay our suppliers because if we ever did, they would be very reluctant to extend us credit in the future. So now, in May, in addition to finishing paying some of the bills from April, we also expect to pay 60% of May's expected manufacturing costs, add in 100% of our cash operating expenses minus depreciation expense, tells us how much cash we need to pay our bills in May. So what happens in June? We're going to pay the other 40% of our May bills, and remember, between what we pay in May for May's manufacturing costs plus what we pay in June for May's manufacturing costs has to equal all of May's manufacturing costs. In addition, in June, we plan to pay 60% of our June manufacturing costs, add in our cash operating expenses for June, and that tells us how many dollars we need in June to pay our bills. Altogether, this gives us a sense of how much cash we need to have available in each of these months to cover our manufacturing costs and our other operating expenses. Let's do a practice problem. We are told that a firm expects to pay 30% of its purchases in the same month that it buys things and 67% in the following month. This firm would never fail to pay a bill, but it does expect to pay within the discount period for merchandise that it buys. So it expects to get a 3% reduction for that merchandise. We're given some information about the firm's credit purchases during a 3-month period. My question to you is, how much does this firm expect to pay in May for purchases? Let's take a look at the solution. In April, we expect to buy $180,000 worth of purchases, and our budget says we expect to pay 30% of that amount in April and another 67% of that amount in May. In addition, in May, we expect to make $250,000 of purchases, and we expect to pay 30% of that amount during the month of May. The 3% cash discount can be ignored because it simply represents cash that we did not have to spend because we paid for our purchases within the discount period. Add up the cash expenditures in May for April and in May for May, and that tells us the total amount of cash that this firm would budget for the month of May. Now, in order to finish our cash budget, we need to know if our firm plans to do anything else with its money besides collect it from customers and use it to pay for our manufacturing costs and our cash operating expenses. For example, our firm may plan to buy or sell capital assets. That is an investing activity. The firm may also plan to issue new bonds to borrow money from the public or to redeem outstanding bonds. It may plan to reacquire some treasury stock or reissue stock. And the firm may plan to pay dividends to its shareholders. These are categorized as financing activities. In addition to that, we also need to consider the firm's cash policy. That is, how much cash does the firm want to have at the end of each quarter for just in case. In case customers don't pay as fast as we expected, in case there's an opportunity that we would like to take advantage of. Altogether, the purpose of the cash budget is in part to help managers plan for the future. When is a good time to buy something that the firm might need, and when is a good time to arrange for possible borrowing? So let's take a look at Acme Widget's plans. The firm plans to buy some equipment in this quarter for $50,000. It also plans to pay its regular $10,000 dividend and to retire $200,000 of bonds. This firm's cash policy is that it wants to have $300,000 in the bank at all times in case it needs it. If the firm doesn't have enough money in the bank, it might want to plan for some borrowing. If the budget suggests that the firm will have more than $300,000 at the end of the quarter, then the firm might want to think, what useful thing can it do with that money? The firm can borrow cash at a 9% annual rate anytime it wants to on a bank line of credit in $10,000 increments. There are two ways that we could express our cash situation. One way is to make a cash budget. A cash budget simply lists all of the expected sources of cash, everything that will bring cash into the firm, and then looks at all of the expected cash uses for the period and determines the difference. The way that I'm going to show you is a budgeted statement of cash flows. It will give you the same answer, but a statement of cash flows classifies cash events as either operating, investing, or financing, and I feel that it's more useful for managerial purposes. So let's do the operating section first. There's only one basic operating activity that brings cash into the firm, and that is when customers pay us. So I went back and I looked at our schedule of cash inflows, and I recorded how much cash we expect to get in during April, May, and June, and we can add it up. That's the total amount of cash we expect to get from our customers during this period of time. Then I took a look at our schedule of cash outflows for April, May, and June, and we can add those amounts up. That gives us the total amount of cash that we expect to spend during that period for regular operating activities. The difference between these two cash flows represents the net cash from operating activities. We expect to end the period with about $176,000 more cash coming in from our business than flowing out to run our business. Now, let's take a look at the other sections of the statement of cash flows. Investing cash flows always come from transactions in long-term assets. If we sell long-term assets, that would be a cash inflow. If we buy long-term assets, that's a cash outflow. In this case, we expect to buy a piece of equipment for $50,000. That would use up cash. Financing activities are always transactions in either debt or equity. If we borrow money, cash flows in. If we repay money that we had previously borrowed, cash flows out. If we issue stock, cash flows in. If we reacquire stock for treasury stock, cash flows out. And if we pay dividends to shareholders, cash flows out. So, our firm plans to pay a dividend of $10,000, that's going to use up cash, and redeem some bonds. Altogether, our financing activities are going to use up $210,000. Therefore, on this basis, if our operating activities bring in a little over $176,000 and our investing activities use up $50,000 and our financing activities use up $210,000, that means net our cash is going to go down by almost $84,000. Assuming that we come into the period with $300,000 in the bank, because that's our firm's cash policy, it means that we will end the period with less than $300,000. So then the question is, what do we do about the fact that if everything goes the way we planned, we won't be able to meet our $300,000 cash policy at the end of this quarter? Well, there are a couple of options. One is we have a revolving line of credit with the bank. We could borrow, we have to borrow in $10,000 increments. We could borrow $90,000 from the bank. Another possibility is don't buy the equipment right now, or buy the equipment but finance the purchase so that we can pay for the equipment in a different period. That won't make up the entire shortage, but it would mean that we could borrow less from the bank. Another possibility is don't pay the dividend. Again, it wouldn't make up the whole shortage, but it would help. Instead of paying a cash dividend, maybe a stock dividend. Finally, we could consider additional borrowing or issuing more common stock. Which of these options to choose is a managerial choice. Remember, one of our basic rules of cost accounting is you can't control costs that you can't see. Going through the budgeting process and making this budgeted statement of cash flows has helped us to see that even though this quarter looks very good, we won't have quite enough cash to meet our own policy at the end of the period unless we consider other options. So the budgeting process has made this situation visible now, before the period starts, so that we can decide what we would like to do going forward before the situation occurs.